Hi, Ben Kingsley here, and welcome to my August economic and RBA update. It is a huge update. There's a lot to focus in on. Let's get to the big themes. Is the world's biggest economy in recession already? That's one big story. Our other big story is around our manufactured economic slowdown is now in full swing with another rate rise today. And finally, our unemployment story is certainly beating expectations in terms of its read in July. So lots of themes to get through. I want to start firstly by looking at the US story. And that US story is one where it's quite interesting indeed. We're going to take a deep dive into the US and look at those three big themes that we saw coming out of the US data this past month. So let's start with the CPI first. Consumer Price Index. We did see inflation blow out again in June, rising 1.3% in the month and was 9.1% over the year. Now, this marks the highest annual consumer price inflation in more than 40 years. Consensus forecast was for a 1.1 monthly growth and 8.8% growth over the year. Now, surging petrol prices were a big contributor to the acceleration in inflation. Energy prices are up 7.5% in June. Food was up 1%, contributing around 0.6 and 0.1 percentage points respectively to the monthly growth rate in headline inflation. In terms of core inflation, which is more indicative of the underlying price pressures, as it removes energy and food prices, well, it also accelerated by 0.7 in June. Although importantly, the annual pace of core inflation edged down marginally from 6 to 5.9. Annual core inflation peaked at 6.5% in March. So this is definitely trending in the right direction. The second of our big three data points is GDP, and now the recession debate is on in the US. Data published by the Commerce Department last Thursday showed gross domestic product, GDP, fell 0.9% on an annualized basis in the second quarter, or a 0.2 fall from the previous quarter. This follows the first quarter GDP data showing the US economy shrank 1.6% in the first 3 months of 2022. So that's basically telling us that we've got a technical recession. This consensus had expected a rate rise, a 0.4% GDP rise on an annualized basis in the second quarter. So this was also below market expectations. In Australia, we mark 2 negative GDP quarters as a technical recession. So on this back-to-back quarterly contraction meets our definition of a recession, although the US relies on a determination of a group of researchers at the National Bureau of Economic Research, the NBER, who look at the broader range of factors. So even though there's semantics playing out here in terms of whether the US is in a recession or not, as far as the regulators are concerned and those people who are looking at it, they're basically saying that they don't believe that they're in a contractionary state and they think that the economy is still growing. So either way, the Fed Reserve had to do their job in terms of taming inflation. And that was the final data point of the big three that we want to look at. So let's look at interest rates. We did see, as widely expected, that the Fed Reserve lifted the US cash rate by another 0.75 of 1% in July. Now, this whole debate around whether the economy is growing or shrinking is because economic data over the past month has been very mixed. And this is making that economic story very unclear. Let's take a look at some of that data. The US jobs data remains very strong, with non-farm payroll grew by 372,000 in June. Now, this was well above the 265,000 that consensus had expected, and just shy of the downwardly revised 384,000 positions created in May. In fact, the net revision to the prior 2 months subtracted 74,000 from payroll, leaving the net additional in June at about 300,000, still stronger than consensus forecast. Jobs growth has cooled relative to prior months, but to the 3-month average increase of 375,000, employment growth remains robust by historical standards. Meanwhile, the unemployment rate held at 3.6 for the 4th consecutive month. Employers are still having to compete fiercely over a shrinking pool of new talent to fill near record numbers of job openings to keep up with strong consumer demand. Layoffs remain at historical lows, and recent data shows about 1.9 job openings for every unemployed person. So very, very strong in terms of economic activity there and unemployment and jobs. Retail sales rebounded last month, rising by 1% after an upward revision of May, showing sales fell just 0.1% instead of the 0.3 as previously reported. Retail sales increased 8.4% year-on-year basis and are 18% above their pre-pandemic trends. Consensus had forecast retail sales would increase by 0.8. The result was driven by more spending on gasoline and other goods amid soaring prices. Manufacturing production slumped for the second straight month in June. Other data also showed further softening demand. The Philadelphia Fed Index, which measures manufacturing activity, deteriorated further in July, falling to negative 12.3 from negative 3.3 in June. This marks the lowest reading since May of 2020. Inside the data measures the business activity, and new orders of 6 months ahead fell considerably, suggesting more challenging economic outlook for the manufacturing sector. However, measures of delivery times continue to ease, suggesting supply bottlenecks may be starting to unwind. Industrial production fell 0.2 in June versus consensus estimate of a rise of 0.1. Every major component except mining missed expectations, and all major components were revised sharply lower in prior months. The University of Michigan's preliminary measure of consumer sentiment for July rose to 51.1 from a record low of 50.0 in June. It remains well below the cycle high of 88.3 recorded in April of 2021. Now, the New York Fed manufacturing index jumped 12.3 points to 11.1 in July from a negative 1.2 in June. The result was much stronger than consensus was anticipating, but detailed data showed a mixed picture. Importantly, some more details indicated easing in price pressures. And what we have also seen is the equity markets in the US are also bouncing off their record bear market lows on the back of pretty good earnings reporting season. Will it be another dead cat bounce, or are investors looking beyond the current economic challenges to a brighter outlook of 2023 and 2024 and beyond? Only time will tell us the judge in terms of what happens in the equity markets. Now, I want to also look at the US housing market. Several months ago, I was really surprised by just how strong the US property market was, but now we're starting to see a slowing happening here. So I wanted to put that spotlight on there because obviously the US appeared to me to be a couple of months ahead of where we were in regards to the Australian property market over that time. So what we did see in terms of looking at the data was existing home sales were weaker than expected in June, plunging 5.4% in the month compared to consensus expectation of a 1.1% fall. House sales have now declined for 5 consecutive months as rising borrowing costs add to affordability pressures. The annualized volume of sales is now at its lowest level in 2 years. In terms of new home sales data, the story is much the same. New home building activity fell to a 9-month low in June, and permits for new construction projects slipped. Housing starts fell 2% to a seasonally adjusted annual rate of 1.56 million units last month, the lowest level since September of 2021. The result was below consensus expectations. And permits for future building, home building, fell 0.6 to a rate of 1.69 million units, also the lowest since September. This has resulted in home building sentiment taking a plunge in July as production bottlenecks, elevated building costs, high land prices, and high labour costs also impacted confidence amongst builders. The NAHB housing market index declined to 55 in July from 67 in June. The index has fallen for 7 consecutive months and was the lowest level since May of 2020. The outcome was well below consensus expectations of 65, and all components fell sharply. Now, there is a silver lining to the housing market slowdown in the US, and we're also starting to see some reports suggesting timber costs have even been easing, and other raw material prices are coming down as activity and demand in the housing sector slows. Now, this is good. This is a good news story in terms of the US tackling their inflation problem. And as we know, with human behavior, consumer consumption also slows when people's house prices start to decline in value. We call this the wealth effect. This broader consumer spending slowdown is also a good story when it comes to slowing demand and seeing prices fall and inflation coming back into check. Now, we can understand that such mixed data, from positive data around jobs and having more jobs and people wanting to take those jobs on that side, but we're also seeing that negative sentiment coming through housing and manufacturing, but consumer sentiment also being up. You can understand why the central bank and the government aren't convinced that they're currently in a technical recession, and they actually think that the economy is still growing. And that is still going to mean that their focus will remain on their inflationary story. Now, why is this important to us, and why have I spent so much time in talking about it? Well, from Australia's point of view, we've got a similar economic story playing out here. We've got really strong employment, but we are starting to see a weakening when it comes to the property market. But in terms of business confidence and sentiment, it's still strong, but is also starting to be impacted by the rising rates that we're seeing here in Australia as well. Now, let's look at China now. Again, obviously the world's second biggest economy. We do want to know what's going on in China because their economy is definitely starting to falter. So we saw that China scrapped out a GDP growth story of only 0.4 in the second quarter from a year ago, missing expectations of a 1.2% number in the second quarter, as the economy struggled to shake off the impact of the COVID controls. In the second quarter, mainland China faced its worst COVID outbreak since the height of the pandemic in early 2020. In quarter-on-quarter terms, GDP contracted 2.6 in China versus expectations of 2% contraction. And that's following growth of only 1.4% in quarter one. The consumer price index came in at a reading of 2.5 from the year earlier, widening from a 2.1% gain in May and the highest in 23 months. Consensus expectations that annualize CPI to rise by 2.4%. The CPI stayed flat month on month on this June reading after a 0.2% drop in May. The pickup in consumer inflation follows a surge in fuel prices, but still remains significantly lower than other developed economies, and we're dealing much around the higher inflation pressures. Meanwhile, China's factory gate inflation cooled in June to its lowest in 15 months. The producer price index, the PPI, rose 6.1 year on year after a 6.4% rise in the year to May. China's producer inflation has cooled for 6 consecutive months. The slower rise in the PPI in May was driven by a resumption of additional industrial production, steadier supply chain in key sectors, and government policies to stimulate commodity prices. This falling factory gate inflation also reflects easing cost pressures on the middle and downstream manufacturers. That's an important note, again, for how we import inflation, with China being obviously a net exporter of their goods. Industrial production in June also missed expectations, rising by 3.9 from a year ago versus a 4.1% forecast. However, retail sales in June rose by 3.1%, recovering from a prior slump and beating expectations for no growth from the prior year. Major e-commerce companies held promotional shopping festivals in the middle of last month, which helped to bump up the result. The surveyed jobless rate fell by 5.5% in June from 5.9. The result was also better than consensus estimates. To help with the economic recovery needed in China right now, the People's Bank of China's governor, Yin Jiang, suggested the central bank will step up efforts to provide stronger economic support amid the pandemic and external headwinds. So you can expect more stimulus spending to come in China. And it appears okay for now, as China's inflationary story is far better than other developed Western economies. China's trade surplus widened to 97.9 billion in June, a new record high from a 78.8 read in May. Over the year, exports have grown faster than imports, up 17.9 and 1% in dollar terms, respectively. The result comes as Shanghai's emerged from its crippling lockdowns, allowing disruptions to manufacturing and also logistics to ease. The Shenzhen Service Manufacturing Index PMI rose to 54.4 in June from a 51.4 in May. It is also above the threshold of 50 for the first time in 4 months. The outcome is consistent with the official PMI in June, released last week, which reported a solid rebound in service activity. Finally, in China, there is a developing story around their property market, with reports suggesting that officials may soon allow homeowners to temporarily stop making mortgage repayments on property projects that have become stalled in a bid to provide further support to the property sector. Prior to this, it was reported that home buyers were already doing this off their own backs because the government's enforced COVID lockdowns had resulted in many project completions to be significantly delayed by such lockdowns and the subsequent supply chain disruptions that lockdowns are causing. So what we're seeing there is basically these people in China just refuse to pay their mortgages because they haven't got the properties in which they're meant to be living in. So the government has had to step in, and I think that also shows the government's willingness to support the property market in China. Turning our attentions to the Eurozone now, we have a couple of weeks back, we saw the ECB surprise markets increasing the benchmark rate by 50 basis points and bringing an end to the negative rates in the Eurozone. Markets had expected a more modest 25 basis point hike in line with the ECB's forward guidance. However, it appears that concerns of runaway inflation outweighed growth concerns despite the impact from the Russian-Ukraine war. Now, this is the first rate hike in the ECB in over 11 years. The main refinancing rate was lifted from 0.00 to 0.5 of 1%. ECB President Christine Lagarde warned that inflation is spreading worsened by the weaker euro and will remain undesirably high for some time. It's likely a further increases in rates will be forthcoming when it meets again in September. The ECB also unveiled its anti-fragmentation tool, coined the Transmission Protection Instrument. The tool is aimed to address disorderly dynamics between credit markets in the bloc arising from sharp rises in bond yields in more indebted countries inside the Eurozone. Activations of programs will be at the discretion of the ECB and will involve the purchase of public sector bonds with maturities between 1 and 10 years. Effectively, it's a market manipulation tool designed to stabilise money markets within the EU and a more broader money system. So again, all of those countries with high levels of debt, which is susceptible inside the EU, this is an instrument that they're trying to bring in terms of protecting that. Consumer confidence sank to its lowest levels on record in July as a combination of rampant inflation, an unfolding energy crisis connecting to the war in Ukraine and fears of potential recession mounts. The consumer confidence index fell to -27 from a revised reading of -23.8 in June. The result eclipsed the low struck mark of April 2020 on the onset of the pandemic. Annual headline inflation was finalised at 8.6% in June, unchanged from the preliminary estimates. This result was the highest annual rate of inflation in the history of the series going back to 1997, remembering the Eurozone is relatively new body. Core inflation CPI index was steady at an annual rate of 3.7, a slight improvement on May's reading of 3.8. Remember, when we do core inflation, we remove food and energy and service costs to see what's underlying there. Retail sales grew by 0.2 in May, despite falling consumer confidence amid elevated inflationary pressures. Spending on food, drinks, and tobacco fell for the second consecutive month, while non-food spending rose. The result was below consensus expectations of a 0.4% gain and followed a 1.4% fall in April. So Eurozone also battling through difficult economic circumstances as the global economy starts to slow under the weight of inflation. Now let's turn our attentions back home to Australia. At today's RBA board meeting, Dr. Lowe and the board lifted the cash rate by another 50 basis points to take the cash rate to 1.85. Now this cash rate is now higher than it was pre-pandemic, but still below the RBA's expectation of where neutral cash rate may sit. And based on commentary previously made, we think that that neutral cash rate sits around that 2.5% mark, and maybe 25 basis points either side of that mark, where the cash rate is not either growing or stimulating the economy or also slowing the economy in any way. So we're still off that mark. So I suspect there's still a bit of heavy lifting to be done there. The $64 million question is how high interest rates are going to go in this cycle of tightening. And that story is still about taming inflation quickly. And this means slowing the economy and the economic growth down by making the cost of money more expensive and slowing down overall consumption and economic activity. Now, the RBA still has not done all the work yet that it needs to do. So there will be more moves to bring that cash rate higher. So that will be informed by the latest data as that comes to hand. If the slowing of the economy is starting to appear, then we might see a move to maybe 25 basis points hike. If the economy is still growing too strongly, then we might see another 50 basis points hike next month. But we are still moving towards that neutral rate zone of 2.5%. Now, whether we have to go beyond this point in the short term is really going to be a decision made later this year with more up-to-date data available. There is a case to overshoot the cash rate in the short term to bring down or put the brakes on the economic growth, but then adjusting that rate back down in, say, 2023. Or there's a case for a softer landing, putting the plane down where it's not going to hurt households unnecessarily, and as their payments start to really bite into their spending decisions. So there is arguments on both sides in terms of if the economy continues to move stronger than expected, they're going to have to continue to put those brakes on. And the signal right now is effectively, right now every meeting up until the end of this year is pretty much a live meeting until they get more of that data on hand. But in terms of just how far they want to go over in regards to what is the neutralized rate is really going to be about what data they see. What has been interesting is where the markets were predicting that the cash rate was going to be as high as 4% only sort of 4 to 6 weeks ago. That has really changed. And now we're starting to see the markets predicting the cash rate around that 3% mark by the end of this year. So the markets may not necessarily have that right, but we'll have to wait and see in terms of what that data says. So that's an important story. Now, the decision to move the cash rate today was on the back of the CPI June quarter data. Let's have a look at that data now. We saw headline inflation rose to a 31.5-year high of 6.1% in the year to June, in the year to June quarter. Underlying inflation stepped up to an annualized rate of 4.9%, the fastest since the series began in 2003. Shortages of building materials and staff, supply chain disruptions, and flooding made the impact. International pressures dominated. Inflation for tradables grew at twice the pace of non-tradables and at the fastest annual rate since 1987. Inflation has accelerated sharply since hitting a trough in 2020. However, the peak in annual inflation rate won't be struck until later this year, where most economists think that the annual headline inflation will peak at around 7 to 7.5%. Underlying inflation to peak likely around 5 to 5.5%. The breadth of the inflationary pressures was reflected in price increases occurring in 10 of the 11 major CPI groups: clothing and footwear, housing, furnishing, household equipment and services, transportation, including fuel, food recorded hefty price rises of over 2% in Q2. Price pressures for non-discretionary items continue to outstrip those of discretionary items. The cost of goods and services, essentially for everyday living costs, surged to a record 7.6 over the year to the June quarter. Non-discretionary inflation delivered an annual print of 4%. The good news is most economists think that we'll be through the worst of it by the end of the year. And in 2023, they expect inflationary pressures to unwind as supply chain disruptions ease and demand slows on the back of the Reserve Bank's rate hike cycle that we're seeing now. And many expect inflation will be back within the 2 to 3 range that the RBA sets itself by around 2024. So that is hopefully good news, that we're able to see inflation as only a short-term element and not a long-term baked into the economy. In terms of what is still surprisingly positive economic news is around the jobs and the unemployment story. We saw 88.4 thousand jobs added to the labour force in June, smashing expectations of a more modest gain in employment. This was the fastest monthly jobs gain since February and takes the level of unemployment to a fresh record high. The unemployment rate declined considerably to 3.5% from 3.9% in May. This is the lowest unemployment rate in the history of the monthly series and the lowest on record since August of 1974, when the survey was quarterly, almost 50 years ago. The Reserve Bank estimates that the unemployment rate between the high threes and the low fours is consistent with full employment. The unemployment rate is well and truly within this vicinity and may even be starting to move beyond that threshold. The strength in the June result is underscored by the increase in the participation rate, which rose to a record high of 66.8. The labour market remains very tight across the country. The largest states of New South Wales and Victoria had the biggest gains in jobs in June. Unemployment rates in those two states fell to record lows. Leading indicators point to ongoing strong demand for labour. Notably, job vacancies hit a record high in May, and reports of labour shortages are widespread. We expect that the labour market to continue to tighten over the coming months. However, we push beyond this full employment, job gains will likely to slow as it becomes increasingly difficult to find the right staff, and that is true in terms of those expectations. Consumer sentiment index falls another 3 basis points to 83.8. Confidence is now down 19.7 since December, falling every month since in 2022. Both level and pace of deteriorations are comparable with previous major shocks. The fall in July means the pace of the sentiment deterioration is now also in line with those earlier periods. The index has now fallen 19.7 since December 2021, a precipitous tumble comparable to the 2 months plunge during COVID's, where we saw a negative 20.8, and the first 6 monthly decline since heading into the global financial crisis, which we saw a 29.7, and the early 1990s recession a 20.5, and the mid-1980s downturn 23.8, and the early 1980s recession of 18.8. So you can now start to see this is seriously affecting the mindset of consumers, and we're now at that stage. So that's got to be playing on the RBA's mind. Rate fears intensified. So the poll showed 73% poll-based RBA expected rates to rise more than 1%. House prices expectations also cooled rapidly, led by New South Wales and Victoria. Now we get into some of the more interesting data. A time to buy a major item, which is a sub-index, was also relatively steady in the July survey, only falling 0.9 of 1%, having posted monthly declines of 3 to 6% over the previous 4 months. So we're now hopefully starting to find the bottom. While a time to buy a dwelling index lifted, which did surprise me, in July to 80.1, it remains at the weak level overall, 39% below its recent peaks in November 2020. The monthly gain was also due to large increases in Queensland and Western Australia, where home buyer sentiment's still very weak. Oh, well, they were strong there, but it's still very weak in New South Wales, holding almost steady at 73.9, and Victoria falling by 11 to 75.7. Meanwhile, consumer house price expectations are continuing to slide. The Westpac Melbourne Institute of House Price Expectations Index declined a further 5.6% in July to 104.9. That's still a pretty good reading. Expectations have dipped into negative territory in New South Wales, negative 6.2 to a reading of 97.3, and Victoria negative 2.4 to a reading of 99. Meaning more consumers now expect prices to decline than rise over the next 12 months. This compares to a much firmer reading of 115.2 in Queensland, albeit from price expectations below a hefty 9.3% in the month. While price pessimists now hold sway in the two big states, there is considerable scope for expectations to fall further. During the last significant housing market sell-off in 18 and 19, in New South Wales, index bottoms at 68.7, while in Victoria, the index hit a low of 71.1. So how do I summarise that? Because this is important for all of us property interested people. The summary is, although consumer expectations more broadly are getting really hit by this consumer confidence story, property prices and so forth are still holding up, and the expectations aren't as dire as what they were during these other periods. But that may continue to deteriorate as we see more and more rate rises coming through. And this reading was before today's increase from the RBA. Retail sales now, we saw Australians continue to open up their wallets in June, notching up the 6th consecutive monthly increase in retail sales and taking the value of sales to a new record high. Retail sales advanced 0.2 in June, taking the annual pace of growth to 12. This is the fastest annual rate since April of 2021. Now, that is obviously a reading for June, where we only saw the second rate increase. We really do need to start to take stock in terms of what's going to be happening in retail sales. So in terms of retail sales moving forward, interest rates are now moving up so quickly that this is going to be a data point that the RBA is going to be looking at critically. What they want to be seeing is retail sales cooling, taking pressure off inflation. So the July through to September retail sales will be some of the most important data that the RBA is looking at. If consumers are continuing to keep spending at the levels that they are, this will put further pressure on the RBA to keep lifting rates, as the domestic demand-led inflation pressures is what the RBA is trying to prevent. If the RBA sees spending declining, this could be a sign that the RBA is now ready to take their foot off the brake, and we'll start to see potential decreases in the cash rate in terms of how much they increase it by, or it could also potentially spell a pause in terms of stopping those rate increases, and then how the economy is coping before making their next move. So it is going to be an interesting couple of months in terms of looking at that data. In terms of business, let's look at the business confidence and conditions data. We did see business confidence slip below its long run average in June, declining for the third consecutive month. Interest rate hikes, inflationary pressures, labour shortages, global uncertainty and supply chain disruptions are all weighing on business at the moment. The fall in confidence was broadly based across states and industries. However, there was a particularly large fall in confidence in the retail sector, reflecting concerns over the outlook for household spending, which we were just talking about a minute ago. Business conditions also edged lower, although remain elevated, reflecting the uplift in economic activity since late last year. Measures of cost pressures reached record high in the June survey. Purchase costs rose 4.8% in quarterly terms, a new high amid ongoing strains in global supply chains. Labour costs also hit a record high, growing 3.6% in quarterly terms as businesses competed to attract and retain staff. Business confidence has been resilient relative to consumer sentiment this year, but we are now starting to see the signs that weaker consumer confidence may be weighing on businesses. Leading indicators suggest that the momentum in economic activity will be sustained in the near term. However, maybe a slowdown in consumer spending later this year, which could in turn have a flow-on effect to weaker business conditions. Turning our attentions now, home run and getting to property. We did see in terms of at the time of recording this update, lending and building approvals hadn't yet been released, but the consensus is that there's definitely slowing activity in broader slowdown on property market plays out. And we're seeing that in the frenetic pace of lending in the past 18 months. So we're definitely going to see lending and building approvals slowing down over this forthcoming period. In terms of looking at the CoreLogic data, we saw that Australian dwelling prices fell by -1.3 in July, and that's marked the third consecutive month that CoreLogic's National Home Value Index has fallen. Now, remembering this is after the national dwelling value surged 28.6 through the pandemic growth phase, and so values are now 2.0 below their April peaks. In terms of the regional markets, we are also now starting to see them weaken, with the combined regional index recording the first monthly decline, -0.8, since August of 2020. Now, this is after the combined regionals index were up 41.1% from the pandemic trough in the June peak, compared to a 25.5% rise across the combined capitals. So let's run through the numbers now on a monthly and quarterly basis. So Sydney down 2.2 for the month, quarterly down 4.7. Melbourne 1.5 down for the month, down quarterly 3.2. Brisbane off 0.8 of 1% for the month, still up on the quarterly basis of 0.1. Adelaide grew 0.4 for the month and is 3.6% up on the quarter. Perth up 0.2 for the month, up 1.2 for the quarter. Hobart down -1.5 for the month, now down -1.3 for the quarter. Darwin positive 0.5 for the month, positive 1.9 for the quarter. Canberra -1.1 for the month, -0.9 for the quarter. Combined capitals -1.4 for the month and -2.6 for the quarter. Combined regional -0.8 for the month and now -0.2 for the quarter, and hence giving us our national reading of -1.3 for the month and -2 for the quarter. So we're definitely going to see some challenges, but again, markets within markets, sentiment is still pretty good in Adelaide, pretty good in Perth, and still also pretty buoyant in Queensland, Southeast Queensland. So there are definitely some opportunities in certain markets. In terms of looking at the rental yields, we are seeing growth in rental yields, which was obviously my big prediction at the start of the year, off the back of very tight rental markets across the country. Rents are increasing on the back of higher costs for landlords to hold their properties, such as increases in their interest rate repayments and compliance costs introduced by the states and territory governments. And of course, yields do look better when they are being judged against lower valuations of those properties as well. So I do expect that the rental market will continue to be very challenging for renters, as reduced rental stock combined with increased immigration will see further pressure on rents. So if we wanted to wrap up the August economic and RBA update, there are a few key and important takeaways here. The RBA still has a bit of work to do in terms of getting to those neutral rate settings to try and curb inflation where they can, remembering that 2.5 is the sort of middle number that everyone is sort of focusing in on. So from your own household budgeting point of view, we are still talking about potentially, half or 0.75, maybe even 1% further increases. And then I suspect you'll see a pause as the RBA starts to then see how that's impacting the economy. From the property market point of view, the story still remains a developing story of those markets within markets. More broader sentiment is definitely on the negative or pessimistic side, but that is also a great time to be a buyer. There's nothing better than when a property market turns into a buyer's market in the short term, because ultimately over the long term, you get better buying opportunities, and we do know that property prices grow over that longer term. So in terms of the real question for me is in regards to what the RBA is going to do around the rates and when they are going to stop that this tightening phase. These 50 basis points tightening phase is having a real impact on confidence and sentiment. So does that then trigger the RBA to bring that down to 25 basis points, which people will say, oh, so the end is near, and that might bring some confidence back, because what they don't want to do is basically overcook that confidence story if they don't have to. So I would like to think that, we might see some 25 basis points if we have to, or a pausing to see exactly what type of impact. But if jobs continue to grow, retail spending continues to thrive, and we're not feeling that impact, they'll have no choice but to continue to keep raising interest rate to cool the economy off. So it's going to be an interesting couple of months. Thanks for hanging around to the end. It is a big month because it's obviously the end of the quarter and the end of the financial year, where we start to see some of that data flowing through in July for this August update and those quarterly results. So thanks for hanging around. It is going to be an interesting couple of months ahead, but hopefully we can then start to see the light at the end of the tunnel and see interest rates starting to cool and everyone realizing that the world isn't about to end. And then we can get on with growing the economy and also growing prosperity for this nation. So thanks for watching, and until next month, knowledge is empowering, but only if you act on it. See you next month.